Why negotiations break down or fail to achieve intended results. An analysis of key factors. Negotiations are a cornerstone of human interaction, from business deals to diplomatic agreements. However, they often fail to deliver the desired outcomes, such as better pricing or favorable terms, or collapse entirely. This paper examines the primary reasons behind negotiation breakdowns and suboptimal results, including misaligned objectives, poor preparation, communication failures, power imbalances, and emotional or psychological barriers. By understanding these factors, negotiators can develop strategies to enhance success rates and achieve intended goals. 1. Introduction. Negotiations aim to create mutually beneficial agreements, yet they frequently fall short of expectations. Whether the goal is lowering costs in a procurement deal or securing advantageous contract terms, the process can unravel or yield disappointing results. This paper investigates why negotiations break down or fail to deliver, offering insights into common pitfalls and their underlying causes. 2. Misaligned objectives and expectations. Point 1. Lack of shared goals. Negotiations falter when parties have fundamentally incompatible objectives, e.g., one seeks cost reduction while the other prioritizes profit margins. 2.2. Unrealistic expectations. Overly ambitious demands, e.g., expecting steep price cuts without concessions, can derail talks. 2.3. Hidden agendas. When one party conceals their true intentions, trust erodes, undermining the process. 3. Inadequate preparation. 3.1. Insufficient research. Failing to understand market conditions, the other party's needs, or alternatives, e.g., BATNA, best alternative to a negotiated agreement, weakens bargaining power. 3.2. Poor strategy development. Entering negotiations without a clear plan limits adaptability and leverage. 3.3. Underestimating constraints. Ignoring budget limits or legal restrictions can lead to unfeasible proposals. 4. Communication failures. 4.1. Misunderstandings. Ambiguous language or cultural differences can distort intent, e.g., a low price means different things to different parties. 4.2. Lack of active listening. Focusing on speaking rather than understanding the other side's position stifles progress. 4.3. Breakdown in dialogue. Interruptions, hostility, or refusal to engage halt negotiations entirely. 5. Power imbalances. 5.1. Unequal leverage. When one party holds significantly more power, e.g., a monopoly supplier, the weaker party may concede too much or walk away. 5.2. Exploitation of weakness. Aggressive tactics by the stronger party can lead to resentment and collapse. 5.3. Perception of unfairness. Even if terms are technically achievable, a sense of inequity can prevent agreement. 6. Emotional and psychological barriers. 1. Ego and pride. Refusal to compromise due to personal stakes can sabotage outcomes. 6.2. Stress and fatigue. Prolonged negotiations may exhaust parties, reducing willingness to find solutions. 6.3. Distrust. Past betrayals or skepticism about intentions can prevent good faith bargaining. 7. External factors. 7.1. Time pressure. Deadlines can force rushed, suboptimal deals or cause breakdowns if no agreement is reached. 7.2. Market shifts. Changes in economic conditions, e.g., price fluctuations during negotiations, can alter priorities. 7.3. Third-party interference. Stakeholders or regulators imposing constraints can disrupt progress. 8. Case studies. 8.1. Business example. A failed supplier negotiation where unrealistic pricing demands led to a stalled contract. 8.2. Diplomatic example. A treaty negotiation collapsing due to cultural misunderstandings and distrust. 9. Strategies to mitigate failure. Align goals through pre-negotiation discussions. Invest in thorough preparation and research. Foster clear, empathetic communication. Address power imbalances with creative concessions. Manage emotions and build trust incrementally. 10. Conclusion. Negotiations break down or fail to achieve better pricing and terms due to a complex interplay of internal and external factors. By recognizing and addressing these challenges, misaligned objectives, poor preparation, communication gaps, power dynamics, emotional barriers, and external pressures, parties can improve outcomes. Successful negotiation requires not just strategy, but adaptability and mutual understanding. Misaligned objectives and expectations. Negotiations often fail when parties don't share a common vision of success. For instance, a buyer seeking a 20% price reduction may clash with a seller unwilling to dip below a 5% cut to maintain profitability. Unrealistic expectations exacerbate this, demanding steep discounts without offering value in return, e.g., larger order volumes, signals bad faith. Hidden agendas, like a party planning to switch suppliers post-deal, further erode trust, making agreement impossible. Inadequate preparation. Preparation is the bedrock of negotiation success. Without researching market rates, a buyer might demand unfeasibly low prices, while a seller unaware of competitors' offers could overprice themselves out of a deal. A weak BATNA leaves negotiators vulnerable, as they lack a fallback if talks collapse. For example, a company unprepared for a supplier's monopoly status might fail to secure better terms due to limited alternatives. Communication failures. Effective communication is negotiation's lifeblood. Misunderstandings, say interpreting flexible terms as payment delays versus volume discounts, can stall progress. If one side dominates the conversation without listening, they miss opportunities to find common ground. Hostility, like dismissing a proposal outright, can escalate into a total breakdown, as seen in labor disputes where talks dissolve into strikes. Power imbalances, power disparities often dictate outcomes. A dominant player, like a large retailer negotiating with a small vendor, can extract steep concessions, leaving the weaker party feeling exploited. This dynamic might secure short-term pricing wins, but risks long-term collapse if the vendor opts out. Perceived unfairness, even in balanced deals, can also derail agreement if one side feels cheated. Emotional and psychological barriers. Emotions can override logic. A negotiator refusing to budge on price due to pride might reject a fair offer, while distrust from a prior bad deal could make compromise impossible. Fatigue from marathon talks often leads to impatience, prompting parties to abandon negotiations rather than seek creative solutions. External factors, external pressures compound internal issues. Tight deadlines might force a buyer to accept higher prices rather than risk supply chain delays. A sudden market shift, say a commodity price spike, can render agreed terms obsolete mid-negotiation. Third parties, like government regulators imposing new tariffs, can also scuttle deals beyond the negotiator's control.